All right, and we are live again. Sorry for starting this late, but better late than never. Oil prices are still crashing. So oil prices are barely holding at $22 a barrel WTI price right now. The Canadian oil prices are even worse. I was shocked to see that Western Canadian Select is only $11.55 a barrel, and Canadian crude index oil is only $8.66. No one can make money at those prices. No one can really make money at WTI prices at those levels. Not even really the Saudis. The Saudis can survive, although recently now, because of bearish sentiment, we're starting to see articles on your screen about negative oil prices down to $10. I'm seeing the craziest oil price predictions lately, including articles coming out about how Saudi Arabia, that came out in the last couple days from Simon Watkins and oilprice.com, how Saudi Arabia could go bankrupt. One of the headlines on oilprice.com today was that, on Wednesday, was that Russia is losing almost $40 billion with this crash in the oil price. So the oil companies, these countries, these national oil companies, these private oil companies are getting absolutely slaughtered. And yet the national oil companies are not cutting production. So, and as you can see on your screen there, the worst may be yet to come, because these articles that have been coming out, I've been keeping track of them. They are predicting that oil demand in the United States, with the quarantines that are happening now thanks to the global pandemic, will collapse oil demand in the US. If you want to read about negative oil, which I don't think is going to happen, where someone actually tries to pay you to use oil, I think that's insanely stupid. I don't see how any logic there is whatsoever. That's even dumber than negative interest rates. Negative oil. Oh my God. Unbelievably stupid. Oh yeah, smash the like button. But if you want to read that article later about this analyst predicting negative prices, it'll be in the information description section. Also, there was another prediction from Goldman Sachs that came out a couple days ago that the, quote, the oil demand collapse from the spreading global pandemic looks increasingly sharp, says Goldman Sachs, which also forecasts Brent crude falling to as low as $20 a barrel in the second quarter, a level not seen since early 2002. Okay, let me see here if they have a lower prediction. Goldman also expects a demand contraction of 8 million barrels a day by late March, and an annual decline this year of 1.1 million barrels per day, which it says would be the most on record. Rystad Energy projects a year-on-year decrease of 2.8 million barrels a day in global oil demand this year. Quote, to put the number into context, last week we projected a decrease of just 600,000 barrels. So the headlines here from some of the articles I'm tracking in the oil market, and I'm not going to have time to read all of them and talk about all of them, include in the last week, and this is nuts. And again, the high-frequency trading algorithms are scanning all these article headlines. They may not read the entire article, the high-frequency trading algorithms, but they're going to scan the headlines. So this article headline was from Svetlana Peroskova. She's a good writer for oilprice.com. She writes a lot of good articles, along with Julianne Geiger and Nick Cunningham, quite a few. There might be one or two other oil journalists I like, but those are some of the main ones. And that's really good free research on oilprice.com. Largest oil glut in history could force crude prices even lower. So this is a supply problem still. The oil market is heading for the largest ever crude oil glut in the first half of 2020, which could be 2 to nearly 4 times bigger than the biggest surplus recorded so far, IHS Markit says, as quoted by Bloomberg. The glut in the first half of 2020 could reach between 800 million barrels and a staggering 1.3 million barrels, between 800 million barrels and a staggering 1.3 billion barrels. Wow. More than 2 and up to nearly 4 times larger than the previous biggest oil glut of 360 million barrels in late 2015, early 2016, according to IHS Markit. The largest ever glut is coming as oil demand is slumping, and this other article that came out the week before from Julianne Geiger, that you can see part of the title on your screen there, is that oil demand in the United States and European Union is going to collapse. I'll read a little bit of that article as well. The largest ever glut is coming as oil demand is slumping due to the global pandemic and former allies Saudi Arabia and Russia promising to flood the market with oil, and then I'll add, with nefarious purposes to kill shale oil. As they are in an all-out price war for market share. Yeah, market share is part of it. They also know that they can take out shale. They're trying again, and they're going to probably successfully take most of them out. The last time, because there's just not much capital available, and I don't know how much more these shale oil companies can cut their costs. Unless the government steps in with a bailout, which brings me to an interesting interview that I'm going to play about 2-minute clip of that Tracy Schuchart, aka Shy Girl on Twitter, she's a professional oil trader, money manager, and she's talking with Eric Townsend of Macro Voices. So I want to get her opinion. I'll play the audio. I listened to the whole interview. I'll put the whole interview link in the information and description section. It's about 40 minutes long, going through all the different things of her analysis of the oil market. But I want to get her, I'll play the clip here about her talking about the possibility of an oil bailout with Eric Townsend of Macro Voices, and also about hedging for these shale oil companies. She's going to go into details about just how stupid the hedging programs have been for the shale oil companies. Okay, take a listen for the next couple minutes.
To make that happen. But frankly, in an election year, you know the way President Trump's opponents are going to spin this is he wants to bail out his billionaire friends in the oil industry at the expense of Main Street America. And it would be met, I think, with a huge amount of public opposition. What do you think is on the horizon in terms of how this might play out and how it might go down?
I agree with you, Eric. I mean, I think it would be very bad optics in an election year to, have these massive bailouts for the shale industry.
Okay, then what's going to happen for the shale industry if there's not a bailout? It seems to me like, in terms of any new drilling, it's got to be off the table for now. Can the shale industry survive on its existing wells, and how long can it survive? We don't know how long this crisis will go on. We figure that, China is starting to get to the recovery stage now, so it looks to me like maybe we've got another 4 to 6 months before we're on the upswing on the other side of this. Of course, you never know when season 2 starts, but how long can the U.S. shale industry survive without a bailout, given everything that's going on?
So realistically speaking, we have about 6 months at these prices because they're really not going to start drilling a lot of new wells. So what we drilled in the last 6 months will carry us forward 6 months, and then that's when we start really getting into trouble.
Now, Tracy, the way this used to work in the good old days is these shale guys would hedge their forward production, and that was normally negotiated through a cashless collar transaction with an investment bank that would then lay that risk off in the futures market. And the idea was that they were pretty much protected. There was a range of prices they might get, but if it got down to the bottom of that range, they would still be able to sell their production at those prices. And that's the whole function of hedging in the futures market. A few years ago, some genius came up with the idea that, the price can't go down that low, so they could reduce the cost of that transaction with something called a three-way collar, where you've got a range of protection, but if the price really goes low, you don't really have all that protection after all, or at least that's the way I understand it. How much do you know about these three-way collars, and do they come into play as we get to lower prices?
They're already in play. So if we take, for example, Oxy, and you can look these up. Anybody can look these up for any companies. I just happen to have Oxys on hand. So what they...
Okay, quick interruption. She's talking about Occidental Petroleum. Okay, back to Tracy Schuchart.
Did is they sold a $76 call. They purchased the $55 put, and then they put a floor on it at $45.
Because it can't go below that. Nobody would ever want to protect against that risk because it could never happen.
So that's kind of where they are. That's one. And then you've got MRO, Marathon Oil, their floor is $47. So a lot of these guys, even in their hedges, are upside down right now.
Okay, so we've really got a cash flow problem, a bigger one than I understood in the shale patch. No wonder Harold Hamm is panicking. And even if President Trump wants to bail him out, I think you and I agree that politically it would be very difficult for him to do that right now. So what would that mean? I mean, I think there's a very strong argument that the U.S. should not risk losing its domestic oil industry. We can't just let the whole industry go bankrupt. That's really, really not good for energy security. It's not good for national security. And, of course, it's not good for the economy. So what do we do, or what happens next?
I mean, I think that, say the worst case scenario happens, we are going to see production declines. We are going to see bankruptcies and mergers and acquisitions. I don't think it's going to get to, a dire point as far as production numbers, how much we can produce. I think that could be reduced. I think you could start seeing it taper off the latter half of this year, given that our 6-month lag time. And then maybe into 2021, maybe see 800 to a million barrel decline in the worst case scenario. Is kind of what I'm looking at. But ultimately, what's going to happen is this industry is going to consolidate more and be more cost effective. So it's not the end of the world for shale. It's just that this time we're going to have a problem because, when we had the crash in 2014, in 2016, you had a bunch of private equity guys that, threw $30 billion first half of 2016 it was. Got everybody excited in this industry again. We started seeing oil prices come up. If we have another crash, well, we're kind of already having a crash scenario, but if we have another crash scenario that way, the problem is the first round was the banks, the second round was the private equity guys, and there just isn't going to be that kind of cash available.
Okay, I'm going to stop her there. So I disagree with some of the stuff she just said. She left out the pension funds because the private equity guys, they dumped it onto the pension funds. So the pension funds are the ones who were the bag holders for this shale oil junk bond debt and a lot of these bad shale oil shares. She said she said it's not really a crash scenario and she doesn't think things are going to get too bad. I would disagree. I think things can get a lot worse, and I'm going to talk about that in a little bit. I'll talk about the balance sheets and some of the problems with the larger oil super majors and why they probably can't do acquisitions, at least in the short term. Maybe they will in a couple months. They have some serious fat trimming to do. ExxonMobil just got some big red flags. They had a credit downgrade, a very serious credit downgrade. If you're not aware of what a credit downgrade means, it's a big deal, especially with a company that has as much debt outstanding as ExxonMobil, and they are on credit watch for a second credit downgrade in the next couple weeks. That is how bad things are. ExxonMobil's dividend payout ratio now is up to 188%, which is screaming that there will be a dividend cut. Meanwhile, all these article writers on Seeking Alpha are writing about how great of a dividend yield ExxonMobil is, and they won't cut the dividend. So the odds are ExxonMobil will cut the dividend. Also, ExxonMobil, and I think this is bad management, this is stupid management in my opinion, ExxonMobil, even after their credit was downgraded and they have to borrow at higher interest rates, pay more to borrow, they went ahead and borrowed another $8.5 billion because, they're a large corporation and their executives think that they can get a golden parachute probably in the next year or two and get out before everything blows up. Not a smart idea after you get a credit downgrade, and then the credit ratings agencies are then talking about a second credit downgrade, which would only make things worse, and then you go and borrow another $8.5 billion. Again, not very smart, and you're telling people that you're going to maintain the dividend. I'm not so sure. In fact, it looks like they may be borrowing to pay the dividend. And with that dividend payout ratio, normally from my past experiences, when the dividend payout ratios get that high, they almost always get cut. Even Chevron's, and remember 2 weeks ago, I think ExxonMobil's dividend payout ratio was 122%. So in only less than 2 weeks, I think, maybe 2 weeks at most, the dividend payout ratio for ExxonMobil has gone from 122% to 188%. The dividend payout ratios are blowing out for these larger oil companies like Chevron as well. I think Chevron's dividend payout ratio was, I want to say it was around 80%. 2 weeks ago, and now it's like 130 for Chevron. So even Chevron's starting to get high. That if oil prices keep going lower, there's going to be dividend cuts from the large oil companies that the market participants are not expecting, that income investors are not expecting, that pension funds that buy these oil stocks with dividend yields are not expecting. So ExxonMobil right now, if you look at the stock, it claims to have a 9% dividend yield. I would call that a yield trap. Again, I've been warning people all for months now about oil stocks. Stay away. It's a falling knife. Months ago, I was saying before the global pandemic that oil stocks could crash when I was ahead of the curve with the global pandemic because of the information I was getting out of China from my friend trapped in Wuhan, that things were going to be really, really bad. And here we are like 2 months later, and things are really, really bad on the demand side for oil. And then the Chinese economy has still, the data that we have for the Chinese economy, it has improved somewhat, but it's still nowhere near the levels prior to the global pandemic. So I have a number of articles if you want to read about the Chinese industrial economic data that's come out in the last couple weeks. Again, I would say it's not very good, but there is some improvement with pollution in terms of factories getting back online. But those factories could be just people running the electricity and blowing smoke up the smokestacks. You know, blowing smoke, you know, the old funny saying, blowing smoke. Anyway, so the large super majors are not in as good a shape to go and consolidate right now. Now that may change. What I would like to see these companies do now, because oil prices don't look like they've hit bottom. Everyone expects them to go lower. All the oil analysts I read for articles seem to think that demand could collapse in the United States, and that's going to cause oil prices to go lower, especially if the Saudis and Russia and the other OPEC countries don't cut back on oil production. That eventually these, what I would like to see done with these oil super majors is for them to cut their dividends, start raising cash, don't take on any more debt, just like ExxonMobil did after getting a credit downgrade and an S&P credit ratings agency warning them about another credit downgrade, and here they are borrowing another $8.5 billion. I'm shaking my head here. You can't see it. I'm just shaking my head. Meanwhile, you're going to see all these articles come out on Seeking Alpha saying ExxonMobil has an amazing dividend. Like there was one guy called like the Dividend Guru or something, and he just wrote an article in the last couple days about how ExxonMobil's dividend is amazing now. Well, look at the payout ratio, and when the dividend cuts, people are going to say, I told you so. It was a yield trap. Just my 2 cents. Anyways, there is a really good article that came out in the last 5 or 6 days. My friend Robert Rapier, who is my oil mentor, I also worked with him for a while. He sent me this after our interview last week. So it is U.S. shale companies' hedges were inadequate for oil price crash by Devika Krishna Kumar and Liz Hampton. This is a Reuters article from March 13th, 2020. Oil prices have plunged so much that even U.S. shale producers who have paid for the industry's version of income insurance must deal with big holes in their budgets. Crude oil prices have crashed about 50% this year, hit by the global pandemic and the surprise price war. And I would call it a price war slash. We're gonna run some spy games here. We're gonna fake our strategy, and we're just gonna kill shale. We're gonna increase production briefly so we can knock the price down, kill shale, and in 2 or 3 years from now, after we're past the global pandemic problems and oil prices are much higher, shale won't be alive anymore. Who have paid, and oil prices might be closer to $100 2 or 3 years from now because of the supply destruction. I mean, Canada, look at the Canadian oil prices I was talking about. Western Canadian Select was barely $11 a barrel. No one can make money at $11 a barrel. U.S. shale producers who have paid for the industry's version of income insurance must deal with big holes in their budgets. Crude oil prices have crashed about 50% this year. I think it's more than 50% because the article came out last week. Hit by the global pandemic and surprise price war that erupted last weekend between Saudi Arabia and Russia. The U.S. crude benchmark on Thursday closed. Okay, I'll skip that part because those oil prices are old. Far below the $50 per barrel price. $50 per barrel price, where many oil companies, U.S. shale oil producers, hedged. With prices at 3-year lows, shale producers also are exposed because they used options in such a way that their insurance erodes the more oil declines. So their insurance that they bought to protect themselves is not protecting themselves. This is another face. I'm not shaking my head this time. This is a face palm. Oh boy. Okay, with prices at 3-year low, shale producers also are exposed because they used options in such a way that their insurance erodes the more oil declines. Quote, U.S. production is likely less well hedged than the market realizes, said Michael Tran, Managing Director of Energy Strategy at RBC Capital Markets in New York. Shale companies protect their revenues with hedges because oil prices can swing wildly due to unforeseen events. About 43% of 2020's oil production was hedged as of the end of the fourth quarter, according to Goldman Sachs. But that 43% is not fully covered. Producers use a variety of methods to hedge production. The simplest is to purchase a put option that allows the holder to sell at a fixed price at a particular time, regardless of where oil prices are trading. That locks in a selling price of, say, $50 a barrel. So this is what Pemex, the Mexican national oil company, did, and they're making lots of money doing this right now. They did a very simple hedging strategy. They did a put option protection on their oil production, and they're making big bucks off their oil hedges. Whereas the other guys did more sophisticated oil hedging, including collars, swaptions, and three-way collars, as Eric Townsend and Tracy Schuchart discuss, and they mucked it up real bad. So all they had to do was a very simple hedging strategy with puts, like with what Pemex did. Pemex, I think, is making billions of dollars off their oil hedges. I remember seeing an article out in the last week or so that Pemex was due to make billions of dollars off their oil hedges. Locks in a selling price of, say, $50 a barrel, fixed price at a particular time, regardless. Totally lost track of where I was in the article. Regardless of where oil prices are trading, that locks in a selling price of, say, $50 a barrel. Many shale producers used a more complex strategy, and this is the problem, known as three-way collars. Producers still buy the put options as insurance, which they just should have stuck with that. Keep it simple, stupid. But they also sell other put options, often with a lower price point, to lower or eliminate the cost of their insurance. Effectively, this is a calculated bet that oil will fall to a certain level and no further. But so that's not really full insurance, it's partial insurance. But that was not what happened. Quote, using many of these structures, producers are price protected unless prices fall below a certain threshold, and $45 a barrel was a popular strike level, at which point producers become fully exposed, Tran said. RBC Capital Markets equity analyst said Marathon Oil hedged about 38% and Pioneer Natural Resources 54% of estimated 2020 production using three-way collars. Marathon and Pioneer did not respond to requests for comment. Marathon was one of the numerous companies this week that announced drastic spending cuts. Futures and options market volumes hit a record on Monday. The CME Group said some shale companies are looking to unwind hedges now. Wow, it's going to be very expensive unwinding hedges, and this is not at the right time because these oil companies have problems with their balance sheets and cash flows because their revenues are down so much. Looking to unwind their hedges, selling the financial contracts to generate cash, market sources said, adding that others are looking to restructure their hedge positions to secure protection at lower price levels. This should have been done in the first place with very simple hedging strategies a long time ago. Instead of a keep it simple stupid strategy, they tried to get too fancy and screwed things up really bad. Quote, our E&P, which is exploration and production clients, are now all reevaluating the hedges they have. Steve Sinos, Vice President of Mercatus Energy Advisors, using the acronym for exploration and production. Occidental Petroleum constructed a complicated hedge that protected their selling price for 2020 down to $45 per barrel Brent crude while leaving them fully exposed to downside in 2021, according to company filings. So Occidental Petroleum, which Warren Buffett and Carl Icahn are fighting over, will have even more problems in 2021 if oil prices keep going lower or stay low for a while. That company cut its dividend by 86% last week and said it would slash spending, which the other oil companies should also do, but they're pretending that they can maintain their dividends right now, and ExxonMobil's even borrowing more debt. A lot more debt, another $8.5 billion, despite a credit downgrade, and it looks like a second credit downgrade coming. By the way, 2 credit downgrades in a very short amount of time, really, really bad red flags. I'm not saying ExxonMobil is going to go bankrupt, but there's going to be hard times ahead unless oil prices rally a lot in the not too distant future. Parsley Energy restructured hedges earlier this month in expectations of falling prices, but those changes were modest and were done before this week's rout. Quote, "The whole industry is not evenly hedged," said Trisha Curtis, co-founder of Denver-based consultancy PetroNerds. She said, that's a cool name, PetroNerds. I guess that's a oil data analytics firm, I'm guessing. She said hedged operators may still need to cut back on rigs and hydraulic fracturing fleets that produce oil and gas from shale rock. Okay, there's more to this article here. The rest will be in the information and description section, including unhedged companies like Apache and Continental Resources. Whoops. Who are totally unhedged and are now exposed at prices this low. Yikes. So Chevron's dividend payout ratio is, I think I said 133. It was actually 131. So I think it was 80%. Maybe 2 weeks ago, their dividend payout ratio. Now it's 131. So Chevron's starting to get dicey there too. Let me take a look at Royal Dutch Shell, since people are going to ask. I know a lot of people were talking out for and increased it for 40 years. Something, it's a long period of time. Okay, so according to this dividend payout on Seeking Alpha here, dividend payout ratio is 124% for Royal Dutch Shell. That's still very high. And I think it was only 70%, so it's about doubled in only a couple weeks. For Royal Dutch Shell, their dividend payout ratio is about doubled. This new article that just came out on oilprice.com, Russia scrambles to save its economy as oil prices collapse. So these countries are really trying hard to kill shale oil. And they may succeed. We'll see if President Trump is able to get a bailout or not, but it doesn't sound like it. But we'll see. I mean, they're bailing everything else out, though, right? If they're going to bail out airlines and hotels and restaurants and God knows what else they're going to bail out. I mean, the stuff with the spending programs, the MMT, QE, stimulus programs, that Republicans and Democrats are both on board with for the most part. And Mnuchin is threatening, 20% unemployment soon if they don't get those spending bills done? Stimulus bills, excuse me. And in the bailout programs. This is just becoming an even worse clown show. And Julianne Geiger's article was talking about how the real oil demand shock is yet to come. Oil demand has been revised downward several times since the start of the year by nearly every analyst or banking institution, thanks to the devastating impact of the global pandemic, with the number of global pandemic cases in China, the world's largest oil importer, seemingly leveling off in recent days. I would not believe that. That 80,000 number that really hasn't moved at all in 6 weeks is complete and total fiction. Complete and total fiction. But enough people believe it, seemingly leveling off in recent days. Some may be taking the view that the worst of the oil demand shocks are now behind us. But more shocks are on the horizon as the world's number one crude oil consumer, the United States. Actually, China is still a very large... I thought China is the largest consumer of oil right now. So I thought China consumes more oil. Maybe they just import more. Anyways, U.S. and China are 1 and 2. Number one crude oil consumer, the United States, begins its own war on the global pandemic. When China first issued travel bans in its areas hardest hit by the global pandemic, oil demand took a beating, and analysts tried to work out just how much oil demand would be lost as it became clear that China didn't have the situation contained. In fact, they covered it up for 2 months. And most people in the West believe the Chinese government. Other countries closed their borders and halted or tapered air travel, worsening the demand outlook for oil. No less jet fuel, less gasoline. You get the picture. On Wednesday, the World Health Organization officially declared it a global... Okay, so this is from March 12th, so I'll skip that part. Adding an opening statement in Wednesday briefing that deeply concerned, but okay, reclassification as a pandemic... Although travel restrictions may intuitively seem like the right thing to do, this is not something that the World Health Organization usually recommends. No Europe to U.S. travel. Nevertheless, late last week, U.S. President Donald Trump halted all travel from Europe except from the United Kingdom. I believe that's probably shut down now too, to the United States for the next 30 days to contain the virus that has plagued Europe. That is exactly the kind of action that ate into oil demand in China. The International Energy Agency warned last month that oil demand for the first quarter of 2021 would sink 435,000 barrels per day, and that's when the virus was contained mostly to China. As of 2017, the U.S. consumed 19.96 million barrels per day of crude oil and petroleum liquids. This accounts for 20% of the world's oil consumption, according to the Energy Information Administration. To compare, China consumed 13.57 million barrels per day in 2017. I thought that I'd seen articles in the last couple of years that China had increased that even more. In the United States, it's more than just a travel ban that will hit oil demand. A full-on panic has set in. Okay, so she's talking about sports, that people travel for professional sports or kid sports, all different levels of youth sports, boys and girls sports, and that all those things are canceled, and that people are going to be self-quarantined, and that's going to kill oil demand. It's going to kill gasoline demand, it's going to kill jet fuel demand, and it's looking like it's starting to play out. We don't have exact numbers on this yet, but I think she's on to something about how demand for oil... I mean, people are still going to drive to like Costco, the grocery store, the pharmacy, to the gas station to get more gas, especially if it's falling in price and not rising. This is the perfect storm. It's late. This is the perfect storm of bad news for the oil market. Things just keep going down that black hole. You cannot see the bottom. It is a falling knife. You cannot see the bottom. It just keeps crashing. Not every single day. Sometimes there's a little rallies here and there. We're going to be below $20, folks. The stuff I'm hearing, I just got information about 24 hours ago. I'll talk about it on another show. Sounds like a couple large hedge funds blew up. Not just one LTCM, long-term capital management, sounds like multiple. And so when the credit markets froze up in the last couple weeks, when the bond markets and credit markets froze up, all those hedge funds, the big hedge funds that were running the risk parity trade, that had enormous amounts of leverage on bonds with investment-grade bonds, high-yield bonds, which are junk bonds, and leverage loans and collateralized loan obligations, they could not sell them. So everyone wants to be a net seller, and there are no buyers in a lot of the bond markets. And that's why you're seeing the junk bond ETFs crash like that. Because everyone wants to go to the exit, and there are no buyers. That's what I've heard. Looks like the Fed's going to have to come in and buy at 100 cents on the dollar. I'll do another show on the exact hedge fund stuff. We'll split it up into another show. But if that's true, things are going to get way, way worse, and that's why the Fed panicked so much, because in the last week or two, we had multiple long-term capital managements. Okay, we got some super chats here. Chicky40 Noobs. Okay, thank you for the super chat. Did a quick Sandstorm Gold trade with 35% gain. When is it a good time to buy and hold miners? Do I suggest gold or silver miners, or just buy royalty and streaming companies? In my opinion, it depends on your risk tolerance. If you want safety, you should stick with the companies that can consistently have high profit margins and better cash flow and free cash flow throughout all different parts of the cycle. So the royalty and streaming companies, the larger ones, are more diversified than mining companies. They have far better margins. They consistently generate free cash flow at all different parts of the cycle, a lot better than regular miners. And normally a lot of miners have to bet the entire company on one or two mines. The other major thing is maintenance capital expenditure, or maintenance capex, and precious metal royalty and streaming companies do not have maintenance capex bills. They invest in growth. There is growth capex. There is a Seeking Alpha article writer who does free cash flow analysis of Sandstorm Gold, and he says it's negative. He can't do any accurate cash flow projections. He doesn't understand the business model, that it has low overhead. He doesn't understand the business model at all, I don't think. that the business is basically pure free cash flow. It has low overhead. It just collects checks, and then they reinvest those checks from royalties and streams. Once those are online, throwing off cash flow, that is reinvested into more growth, into new royalties and streams, or to pay a dividend at some point. If it's Sandstorm Gold, Franco-Nevada has increased dividends every year since 2007, or to buy back shares. If shares are a lot cheaper than the company's internal net asset value calculations or whatever other valuation multiple they are using. Thank you for the super chat, Justin. I appreciate it. Another super chat from Jarek. Thank you, Jarek, for the $10. Will precious metal paper markets crash and physical moonshoot? I did not look at the gold and silver prices today. I was busy actually helping both my parents run a bunch of errands and get them groceries and stuff at Costco because they are terrified, paralyzed with fear, really, about the global pandemic. My dad has a bunch of health problems that make him very, very high risk. He's in bad shape. He's a retired doctor, a lot of health problems. So he is not leaving the house, and I had to help him out. I spent hours today running errands all over the place today, helping him out. Buying him stuff for the next couple weeks or month. So I'm sorry, I did not look at... But I know it's starting to look that way. I think, Jarek, what's happening in the paper markets is I think there's margin calls, just absolutely massive margin calls. And I think this has to do with some of those big hedge funds that are blowing up, that they're selling their gold positions that were profitable. So I think that's it. But we're very similar. The paper markets and physical markets, what's happening now is very similar to what's happening in 2008. Which is where the premiums for metal are going insane. And for a short period of time, the mining shares, even the best ones, crashed. And the paper markets crashed. And then within 18 months, after the crash there, we were at, 1900 gold? We were at 1900 gold, and we were at 48 silver. Before they got control of the markets again with manipulation. Although this time, with the amount of spending programs, with the amount of MMT, QE stimulus programs and bailout programs being proposed, and the currency swaps, and the Federal Reserve announcing a QE, and all the infinite repo madness. Now, they weren't all these hedge funds and investment banks and large banks were not borrowing $1 trillion today, I don't think, but still. For them to even want to propose $1 trillion per day in repo is freaking nuts. Shows you that the problems were a lot larger than they wanted people knowing about. Okay, let me see if there's any more super chats and then I'll wrap this up. I have one more question here about cash on hand. I've always advocated to have some cash in case of a stock market crash. You want dollars. So it's always important to have some cash. Dollars give you options. You don't know how low the oil prices are going to go. You don't know how low the gold stocks are going to go. You don't know how low quality companies like Disney are going to go. Disney is going to eventually, a couple years from now, when we're through the global pandemic, Disney's going to mint money again with their theme parks and movies. They have quality brands. They make a lot of money with their movies and theme parks and entertainment division. Right now, though, I would not want to own any Disney shares. They have a lot of problems. The movie theaters are closed. They pushed all their Marvel movies and TV shows back. The theme parks are a mess. I don't think anyone's going to them, and I think they close them too. Actually, for Patreon account contributors, Disney was a likely candidate to collapse. I wrote an extensive article on Disney a couple weeks ago that was predicting that Disney shares were probably going to collapse, along with a lot of the hotels like MGM Grand, Marriott, Hilton, hotels and casinos. Airlines I was warning about for months now. When I found out the information from my friend trapped in Wuhan, how bad the global pandemic was there, I was worried about oil then. So this was a couple months ago. I was really worried about oil then. I was really worried about airline stocks then. And they hadn't even started the travel bans yet. I was already worried. So you can go back into the archives if you don't believe me. For my Patreon account contributors, they saw the articles, they saw the chart work over the last 6 weeks or so. A lot of these warning people. Don't be long any of those stocks. Okay, well, I think that's it for the show. The articles I discussed, along with the articles about the Chinese economy, will be in the information and description section below. Thank you very much to my over 500 Patreon account contributors who are allowing me to pay my bills and grow my business while YouTube continues to censor the crap out of this channel. So I basically make almost no money from Google AdWords revenues now. So the Patreon account contributors are doing an amazing job allowing me to provide free content here and also pay my bills. And then there's a lot of bonus content behind the paywall as well. Thank you very much to my I think there's still a few monthly PayPal contributors, and people throw me a tip once in a while. I see people asking in the comment section here about crypto. I know it's falling and it's crashed a lot. Maybe I'll do a show on that in the near future. But I do take tips in crypto, so if you want to be a contrarian, if you want to chip in, I won't sell the crypto. I'll just hodl it. I don't have a lot of crypto, but maybe I'll keep it as a hedge. Because you know what? If these central bankers... Did you guys see what the ECB just announced? The European Central Bank just announced another 750 billion. Insane. All the stuff... The amount pledged in just the last 2 or 3 weeks is insane. We're easily over 10 trillion now. Easily. From all the press releases. And I think we're just getting started. Now, the real economy is not going to recover anytime soon. I have not seen any improvement. The real economy here in the U.S., things are just going to get worse. There's no hint of a vaccine anytime soon. The amount of people infected is increasing rapidly all over the place. But if the Fed prints enough, maybe there'll be some crazy amounts. Maybe there'll be, at some point, really, really bad inflation. Worse than the stagflation we have now in the real economy. Oh man, my voice is starting to go. Worse than the stagflation that we have now in the real economy.